And we are now moving on to this resolution. The stock market is too high. The first person to take on this issue is Dambisa Moyo. Dambisa Moyo, on the resolution, the stock market is too high. Do you declare yes or no?
I declare yes. Some of the arguments have already been made. The underlying growth prospects, which should support corporate activity and long-term investment, are getting much weaker over time. But perhaps the most important indicator that the stock market, to my mind, is overvalued or is certainly run over its skis, is the fact that the dividend to retained earnings ratio, which is the ratio of how much money corporates are giving back to their shareholders versus what they're retaining for more investment, has been over 100% in virtually every sector over 2017. This means that our CEOs, the very same CEOs who are at the helm of many of the America's greatest corporations, do not believe that there's a long-term prospect for investment that is actually going to generate returns above the cost of capital. So in that respect, I am concerned that the stock market has gone much further than it should have. The risk-reward in many of the stocks is now actually deteriorating. And more than that, I would say we do know that a lot of the support has come from low interest rates, loose monetary policy, and to the extent that we are expecting, or the market is expecting, and pricing in 3 rate hikes this year, and that means there'll be a drain on liquidity in the system, I think that we'll start to see quite a significant correction.
Thank you, Dambisa Moyo. The stock market is too high. Simon Johnson, do you declare yes or no?
I say no. I'm an immigrant to this country. I see a couple of other immigrants on the panel with me. How many people in the audience here are immigrants, were not born in the United States? Yeah, so
can you do a round of applause so people can hear you?
Only New York.
Yeah. Well, I see about a quarter of the hands go up. What an incredible country. What an incredible country. They can bring people here, they can give them opportunity, they can put them to work, and they can have them pay tax. That's a combination that matters here. No one else in the world can do this. No one else in the world has been able to do this in the past, not like this, and no other country in the world will be able to do it in the future. What is the stock market? The stock market is the value of the profits, the future profits, expected profits of all the companies that are based in your country. It's based, though, that the fundamental value of that is you. It's you as consumers, it's you as producers, it's you as workers, it's you as families. Now, we may disagree, for example, Stephen and I, about exactly what it would take to get growth higher. And that's a fantastic debate. And I'm from a country that prides itself on its democracy. This democracy is a lot better than the one I came from. We have the discussions, we work things out, we have the problems. Now, I happen to think that the policies of this president, if I may use a technical term, the kind of term he likes to use, I think his policies are rubbish. Doesn't matter. We're having the discussion. We will work it out. We will be a greater country, a bigger country with more profits, and eventually that drives stock prices. Eventually, not commenting on short-term stock prices, ever. We will get there after this president.
Thank you, Simon Johnson. Stock market is too high. Jason Furman, do you declare yes or no?
I'm going to declare no for exactly the opposite reason that Simon declared no. Both grounded in the same equation, which is the stock market is the present discounted value of corporate profits. Corporate profits are the fraction of GDP that goes to corporations. That fraction has risen a lot in the last 15 years. I would expect that fraction to rise more still. Things like the corporate tax cut that we've seen will raise that fraction. So without any increase in GDP at all, just a larger fraction, about 30% more than historically, going to corporate profits justifies a higher stock valuation. The second thing that justifies a higher stock valuation is the denominator in that equation, which is the discount rate. That's taking things from the future, moving them back to the present. The way you do that is you look at what your alternatives are, and your alternatives right now are bonds, which have an even lower rate of return. And so when you're taking those things to the future, you're comparing how you could do in the bond market to how you could do in the stock market. All of a sudden, it makes that little extra return look attractive, justifying a high valuation as well. The flip side of this high valuation, though, is a low expected return in the stock market going forward. It costs us about $27 for each dollar of future earnings that we're generating. That's an underlying rate of return closer to 3 or 4 than the 8% we've gotten historically in the stock market.
Thank you, Jason Furman. Gillian Tett, the stock market is too high, yes or no?
Well, just to get some more debate, I would say yes, because one reason why the kind of numbers that Jason's been talking about make sense is if you believe that interest rates are going to stay low for a long, long time. As I said before, if you think you're going to have growth, then it's hard to keep arguing indefinitely that interest rates will always stay low. And if you think that interest rates are going to stay low, then you have to believe that central banks will keep pumping up the global economy by keeping policy super loose for a very, very long time. Asset prices of all sorts around the world have been elevated by an incredible tsunami of liquidity from central banks. I mean, around $10 trillion have gone into the global economy or the financial system under some measures, and that is a lot of money. So I think that sooner or later, central banks will be forced to start reining that in. When that happens, I think people will be shocked. I think we've been living with this impression of calm for a long time, which has been partly pumped up by what central banks are doing. And I think that as interest rates do go up, then stock markets will start to look a lot less attractive. And if you want to find a sign of just how much spare liquidity is floating around, and as Jason says, just how hard it is to find places to put your money if you're worried about stocks, just take note of the fact that right now, my 14-year-old daughter has friends in her class who are busy buying Bitcoin, because such is a mania. If you're a teenage boy, Bitcoin is big right now. And that, to me, is a sign of a frothy financial world.
Thank you, Gillian Tett. The stock market is too high. Stephen Moore, do you declare yes or no?
Well, I'm going to say a non-emphatic no. First of all, let me say I can hardly improve on what you said, Simon. I agreed with virtually every word you said except the stuff about rubbish and Trump. But other than that, no, look, I think you put it very well. You invest in the stock market because you're investing in America. You have optimism about this great country, and I think Simon put it so well as an immigrant. So I have no idea what's going to happen with the stock market next week or next month or even a year from now. I don't have a clue. But I do know that the long-term rate of return on the stock market for the last 120 years is 7% real. How many of you in this room are under the age of 40? A lot. The single piece of most important advice I can give. How many of you under 30? The most important advice I can give you is start investing in the U.S. stock market right now. Right now. If you want to become a millionaire, a pension millionaire, invest 10 or 15% of every paycheck you earn in the stock market, and you will get rich. The stock market, it fluctuates. It's a roller coaster, but its long-term trend is up, and that trend will continue. But the final point I want to make about this is it's a point that Simon made earlier, which I think is true. Donald Trump ultimately will not be judged by voters in terms of what happened to the stock market. He will be judged as to whether he can improve the real economy for people in those states like Pennsylvania and Ohio and Wisconsin and West Virginia and Kentucky, people that frankly didn't feel recovery under Obama. And if Trump is to be a success, he's got to bring hope and economic development to those areas.
Thank you, Stephen Moore. Let's discuss. I'm interested in the last point you just made, Stephen Moore, and I want to bring it to Jason Furman, that you do not feel that President Trump will be judged by how folks do in the stock market. Jason Furman, you agree with that?
Absolutely. About half of the country is not invested in the stock market at all, directly or indirectly. I agree with Steve's financial advice. I'd make it a globally diversified portfolio, and I don't just say that for the points I made earlier. I would have said that a year ago as well. What people care about are jobs and wages, and wage growth right now is real wage growth about 0.4. That's slowed from the real wage growth that we had in the last 4 years of the Obama administration. Unless that real wage growth picks up, it's not going to be very pretty for a lot of people in this economy.
We heard a lot in all of your comments about the role played by interest rates and how they've been low for a long time. Gillian Tett, you made the argument that you think people kind of think that's normal. because it's been going on for such a long time. But outgoing Fed Chair Janet Yellen said that the weakness in 2017 inflation ratings are not going to be permanent. So should we be worried about inflation in 2018, Dambisa Moyo? And should we be worried about interest rates as a result of that?
So we are already seeing inflation in some places. The UK has already seen an uptick in inflation. There's a reason the market is pricing in potentially 3 rate hikes this year. People are concerned about a reduction in supply of labor, supply of other inputs into manufacturing and into businesses. So I do think we are going to see inflation. There's a lot of reports swirling around, certainly in my email box, of where the inflation has been hiding. And where it actually we might see an uptick in that. I mean, the truth of the matter is, I believe we are on borrowed time. If you look historically at booms and busts, certainly through the 20th century, on average, and I'm sure my colleagues here will correct me, the sort of trough to growth is around a 6-year cycle. We're now, as far as I'm concerned, 8 years into this. The stock market has in the past been supported by the baby boomers who were doing exactly what Stephen suggested. They were invested. Those are now in retirement. They're now taking their money out of the stock market. There's lots of evidence of that, moving it into bonds. But more fundamentally, I think that the inflation picture and the risk of inflation does mean that we have a series of rate hikes, not just in the United States, but I think the prospects of interest rate hikes and inflation around the world will mean that there's sort of a setup for a more challenging economic picture.
Jillian, your take on that same question?
Well, I'd agree with what Dambisa says. To my mind, if you want to believe that inflation is going to be low forever and rates are going to be low forever, you have to basically believe that this time it's different and that technology and computers and this magical little device here called an iPhone or smartphone has somehow ushered in a world of enormous disintermediation where all the prices will keep falling online and that will have an impact in the real world. And maybe that's true. Maybe we're all going to have the Uberization of our economy. Maybe we're all going to end up, competing in the labor force with everyone else across the planet because of internet. Maybe we'll all find ways to go shopping very cleverly and price compare for everything online, and that will keep suppressing prices forever. But if you believe that, it's very hard to keep, painting a picture of a permanently booming economy where everyone feels that their job's secure and they have a lot of confidence as well. So there's a kind of intellectual contradiction in what's going on. And I come back to this core point. Somehow, very stealthily, very quietly, central banks have slipped an extra $10 trillion into the global financial system, and almost no one's noticed. They've done it so slowly and so gently over so many years that we've kind of got used to this kind of new normal. And they've essentially taken a patient that was addicted to heroin, i.e. private sector credit, all those subprime mortgages, and weaned them off that by giving it morphine instead. And eventually, that is going to have to come to an end. And withdrawal is never nice.
Simon Johnson.
I liked it better when Gillian was talking about Agatha Christie. I thought that was much more upbeat.
Tell us about
and the murders in the library and so on. Look, the central banks saved the day. Please, I understand that forgetting history is an American pastime. I get that. But please, it's not that long ago when we were seated in auditoriums like this discussing and debating how the world was about to end in the fall of 2008 because of the financial crisis, because of the ways in which big banks and a lot of other people had got over-leveraged and the whole house of cards was coming crashing down. Central banks saved the day. Now, did they provide an enormous amount of monetary stimulus? Yes. Did they break every single record multiple times? Of course. Do we now have many questions about how we withdraw this? Yes. Have the central banks behaved with extraordinary responsibility to this point and with a great deal of caution? These are very serious people, and full disclosure, most of them got their PhDs at MIT, so we need to diversify that. But they've been extremely careful. They've done a good job. There are many risks ahead. Prices go up, prices go down. Stephen and I are absolutely agreeing on that. There are risks, and I don't think anyone at the back should take from this discussion any idea that stock prices would ever, under any circumstances, go up in some linear fashion at any particular rate. We have volatilities. We have risks. You should read the Financial Times.
Thank you.
Jason Furman.
Absolutely.
Yeah, I mean, I think Jillian is exactly right that if you want to answer this question of if the stock market is overvalued or not, what you want to know is where interest rates are going to be 5 years from now. If the 10-year Treasury is 5 or 6% 5 years from now, I'm going to be wrong, and I think that's a distinct possibility. If they're more like 3 or 4, I'll probably be right, and I think that's a little bit more likely. To decide between the two of those, you have to ask, do you think central banks are all-powerful, creating reality, or do you think they're being handed a reality and accepting it? I think the model for interest rates is a little bit more the second than the first. If you look, interest rates were falling from the early 1980s steadily through 2007. This isn't some new function of monetary stimulus. This is an underlying decline in the equilibrium interest rate worldwide, a combination of people saving more, partly because of inequality, investing less, partly because of lack of competition, driving down the rate of return. I think the central banks, for the most part, have just been accepting that reality, and there's quite a good chance that that'll be persistent. Part of why I think that is economists don't have a very good track record at predicting on interest rates, have always predicted too large an increase. They've always come in below what was expected for 40 years now, and I think it's more likely that will happen than the opposite. I'm not positive, though, and so Jillian could be
Stephen Moore,
right
would you like in on this?
So you all probably think I'm a know-it-all, so I'll tell you that I've been wrong on the inflation and the interest rate story for the last 6 or 7 years. When you guys came into office, I predicted there would be inflation as a result of this monetary action, and it didn't happen. So I was completely wrong on that story, and you know, I talk to financial groups all the time. I always have said for the last 6 or 7 years, you know, the one prediction I can make with certainty is that interest rates are going up. They're not going down, but I've been wrong every year because they just keep going down lower and lower.
Don't be too hard on yourself. It's a common mistake.
Well, right. So just a couple quick points on this. It gets to your point about, do you believe that technology can keep, you know, lowering prices? And I do believe the two powerful forces in the universe right now economically are international trade and technology. And those are the factors that have really led to stable prices, which is a very good thing. The other point I would make is here we're fretting about, gee, do you think the inflation rate will go from 2% to 2.5% or 2.5% to 2.75%? I mean, how many of you are old enough to remember 14% inflation under Carter and 20% mortgage interest rates? We're not in that kind of environment anymore. I don't think it's coming back. The two areas where I care a lot and worry most about inflation are education and healthcare, the two industries that have had runaway inflation and the two industries that are run by government.
I have one final question. One final question for someone on the panel. I think I heard from you, Simon Johnson, that your argument against the motion that the stock market is too high was a sort of general core optimism about America, and that ultimately it might be a little bit high now and might pull back a little bit, but it's going to go and go and go and go and grow. And someday, whether it's not really justified today, 25,000, 26,000, which it passed today, is going to be justified. I'm wondering if anybody thinks that's naive, or do you all buy into Simon's argument that the stock market really can't be too high because this is a great country and a great economy?
I'm going to risk it, especially since I'm an immigrant. I'm
Don't be so moral.
risking getting carried out here. So I feel like some of my colleagues are actually being a little bit schizophrenic, because in the earlier conversation, they expressed a lot of concern about long-term economic growth in this country. And if you think about the three key ingredients for economic growth: capital, how much money you have; labor, which we alluded to earlier, the quality and the quantity of the labor force, as well as productivity, it would seem to me that there's a lot of scope and reason for concern. In terms of capital, we've talked about debts and deficits. In terms of the labor market, we've talked about not only the reduction in terms of the workforce, but I mentioned to you earlier the OECD PISA statistics around the quality, especially in a world where immigration is becoming much tighter. And by world, I mean US. And then finally, this question of productivity, which I again mentioned earlier, is really, if you look at many economic reports, this is the largest contributor to economic growth of the three. We don't know why, but productivity has been declining quite considerably, even though we've seen significant advances with the advent of technology. So to me, I'm not here to say this is the end of America and it's never going to ever recover. But I think it's a little bit naive to be so so optimistic that the stock market will continue to go up. And I'm not saying that there's, I understand that there is volatility as we move from one place to another, but I do think that then it requires a lot of caveats, because I do think that America is in a very precarious and different position than it has been in the last several decades.
Okay, I'm going to do a 1-minute extension to let Simon respond. I just want to clarify that when I was talking today, as we took the stage, the Dow Jones Industrial Average broke a new all-time record, crossing 26,000, pulled back a little bit, but that's the trend that we're in. Simon Johnson to respond to Dambisa Moyo, and then we're going to wrap.
John, and thank you for letting me clarify this, because it's very easy to get misquoted on this. My view is that discussions of short-term and immediate prospects for stock prices are absolutely fascinating. I can sit and listen to them all day. They are totally meaningless. Prices go up, prices go down. We don't know what's going to happen any more than you do. Good luck out there, okay? But there is a very serious issue which Dambisa was starting to get at, and I hope we can explore in the remaining section, which is the long term. And the long term is about the country, and the long term is about people. Now, it's a bit, or even importantly, about the distribution between people and across people. That's the point that Jason made. And, Jason, Stephen, and I may have different views on that. Fine. But do you believe in America as a place for people to have families, to get educated, to be innovative, to build companies, to pass money on to and wealth and ideas onto their children? If you believe in that, then you're believing in the companies of America. By the way, not all of them, unfortunately, in the stock market. We get too fixated on the ones already listed. We should fixate much more on the new businesses that are being created and have not yet been created, or don't get created because something gets in the way. But does enterprise prosper in a way that prosperity is shared with everyone across America, including, Stephen said, people who are forgotten, people who are in places or types of places that have been forgotten of late? That's the agenda, and I hear that as the shared agenda tonight across this panel. And with your applause, you can make it shared across the room.
And I'm going to call that a wrap on discussion of this resolution. The resolution, the stock market is too high.